Good afternoon, everyone. This is Anthony Alaka with Dory Hills Capital, and welcome to the Millennial Precious Metals webcast for March 24th, 2022. I hope everyone's doing well, and thanks for taking the time to join us today. We're very excited to bring you Millennial Precious Metals. They are a Nevada-based exploration company with 7 properties in Nevada and a newly acquired property in Arizona. The company is starting an aggressive drill program at its key assets with a PEA expected later this year. We feel the company is well positioned to be a million ounce plus producer in the future for sure. And Millennial Precious Metals trades on the OTC market under the ticker MLPMF and on the TSX Venture under the ticker MPM. It's currently trading about 46 cents per share US, representing a market cap of only $75 million. Company has a very strong balance sheet, high percentage of institutional ownership, and is trading at a discount to its peers. So we feel that there is plenty of upside in the stock as the company continues to execute its strategy. And as we were just talking about, before we got started here, based on the current outlook for higher inflation in the U.S., as well as the geopolitical issues right now, gold prices are expected to move higher, making precious metal stocks very attractive. And so we feel that Millennial Precious Metals is well positioned to benefit from the positive outlook for the space. With us today to discuss Millennial Precious Metals operations and the growth strategy going forward is the company's president and CEO, Josh Kosec, and the company's VP of Corporate Development, Jason Banducci. Welcome. It's great to have you both on today. And thanks for taking the time to introduce our viewers to Millennial Precious Metals. Obviously, a lot of exciting developments are happening with the company and the sector, and I'm excited for you to share those with our group. Before we get started, everybody on the call knows the format. If our viewers have any questions, I think the best and easiest way is to simply type a question into the Q&A or chat box, and we'll make sure that it gets answered. So with that said, I'm going to turn it over to Jason Kosec, who's going to take us through the presentation. Then we'll open it up for Q&A. So with that, Jason, the floor is yours.
Thanks a lot, Anthony, and thanks for your listeners for chiming in today. Much appreciated. I'll give you a little bit of background on the company, the team, and bring you through the assets that we've selected to build this portfolio, and then put in the value proposition of why Millennial and why now. By way of background, this company was started over 2 years ago in a private company. And unlike most companies in the junior space, we did over 337 site visits, 337 desktop reviews, 47 site visits. So looking at multiple projects throughout the Great Basin. And these projects were selected for a number of reasons that we'll touch on today. What we're doing is building a multi-million ounce, multi-asset production company and focusing on near surface heap leachable ounces in the best mining jurisdiction in the world. Why we're focusing on those is the unique combination of grade to strip ratio is very important for your margin. Heap leach projects are very low capex, and they are least susceptible in an inflationary environment that we are in today. And one of the most important thing is and what most people don't know is that the reason why 50% of the reason why mines don't go into production is not because of economics. It's usually because of geopolitical, environmental, and permitting. And Nevada being the #1 mining jurisdiction in the world by the Fraser Institute, it's the 4th largest gold producer if it's its own country. So we look in areas that we can remove 50% of the risk right up front. And that's really why we operate in Nevada. It's important to know that our team, myself, Terry, and Ruben, we've done this 7 times. We put up over 59 million ounces of discoveries across 7 projects, and 5 of those projects are in construction and production today. We're not reinventing the wheel here. What we do and what we've done in the past is we go into old projects where the geologist maybe forgot to do something, maybe he was using the wrong geological model, maybe there was gaps in the claim block, or there was a permitting issue. And the projects that we're going to really focus on today are Mountain View and Wildcat. And that's exactly what happened with these two. They came from a company, Allied Nevada, and they are going bankrupt with the Highcroft mine. And now Highcroft is going bankrupt again and just got bailed out by AMC, I guess. But it's important to know that Mountain View and Wildcat were part of their growth portfolio, and they didn't have the financial or intellectual capacity to develop these projects. Then they were bought out by Waterton, and they came from Waterton. And here, Waterton's a $2 billion private equity firm that does not do any exploration. And herein lies the opportunity today. Wildcat and Mountain View, like I said, are development stage assets. They will have an updated resource in Q3 and a preliminary economic assessment in Q4. They host the 1.2 million ounces of oxide that currently sits there. They are taking the brunt of the 20,000 meters of drilling. So, real heavy focus on them. And then a small amount of drilling is at our Red Canyon asset. Red Canyon sits in the heart of the Battle Mountain Eureka Trend, 35 kilometers south of the Cortez Complex. For people who don't know, the Cortez Complex is the richest deposit in Nevada. It's owned by Nevada Gold Mines, which is the merger between Newmont and Barrick. The current cash balance is actually at 12.5 million. That was at the end of the third quarter of 2021. The team, as I mentioned, we're big company geologists. I'm a structural geologist and then did an MSc MBA. I come from the Talisker group with Terry and Ruben, and we did all the technical due diligence for all Osisko related companies. Ruben is a PhD magmatic epithermal geologist. He was the head geologist at BHP and Anglo Gold Ashanti. At Anglo, he discovered the Las Colossus and Gramalote, which is combined over 30 million ounces, and discovered Escondida East, which is over 2 billion pounds of copper. Terry was with him at Anglo Gold Ashanti. Mike Leskovic runs a fund called Northfield Capital. Sarah Heston is a business professor at Stanford. Eric Tremblay is a mining engineer. He built Canadian Malartic, which is Canada's largest gold mine. You have Raphael Duteau, who's our VP of Exploration from Iron Gold. He's a PhD as well in geostatistics and resource optimization. And you also have on the line today, Jason Banducci, who is 7 years of investment banking and really left his role there to kind of come to the issuer side. And he's been pitched multiple times and really made a career move for this company. One of the things that will stand out, and you will not see this share roster on companies sub $100 million market cap, is the institutional ownership. Over 50% institutionally owned. From Merck, which is Peter Militis, is a division of the Oppenheimer family. Eric Sprott himself, not the fund. Very important to know that. Vescor is a $20 billion pension fund out of Halifax. NewGen is a fund in Toronto. I think everyone's familiar with Franklin Templeton. Century is one of the largest funds in Canada. And Broma is the Lundin family office. As I mentioned, insider ownership, 11.1%. I myself, I'm 34 years old, hence the name of the company. I've put over $625,000 of my own cash into this company. So I've paid for every share I've gotten. If I was Richard Wark, 625,000 isn't a lot of money, but for a 34-year-old, it is. We've been trading since May. So the last financing was done. It was a sub-receipt financing done in January of 2021 for 24 million at 50 cents, straight common, no warrant. The warrants were broker warrants for the financing. Options and RSUs are all management options and RSUs at 50 and 63 cents, I believe. What these analysts are modeling, and Jason Banducci or I can gladly send you their research, is really something that is, when you look at it from the PEA that will publish, around a $400 million NAV. For developers, In Nevada, you usually trade at 0.5, 0.6 multiple to NAV. So you're looking at something that's going to be producing, 100, 125,000 ounces per annum for 9, 10 years. And looking at cash costs, all in cash costs of around $950, $1,000. So we build these businesses on margin, and in any gold environment, we make money. And I'll show you that later on in the presentation. I think it's
And
very
Jay, just
important.
just quickly gonna jump in, just so everyone knows, all the prices that the other Jason was quoting is all in Canadian dollars. So if you look at where we went out, it was 50 cents Canadian. We're up over 15% right now. And if you look across the sector, there's not a whole lot of junior gold explorers that have held value like we have. And I think that just shows you the quality of the management team, the shareholder roster, and ultimately the quality of the assets.
Yeah, thanks for that, Jay. Sorry, I should always mention when I'm talking to people in the US that those are target prices are in Canadian. I think it's really important as we build our brand as Millennial and really building the next generation of a mining house that the previous generation didn't do a really good job on explaining on what we do as an industry. And unfortunately, our generation, the millennial generation, the younger people, think the eggs come from the fridge, so to speak, and they don't understand that mining is a key pillar to our society, and it can be done in an environmentally and socially sustainable manner. So we will be putting out annual ESG reports as well. I'm going to get into the assets. As I mentioned, I'm a structural geologist, so I'll keep it high level for everyone. If you want to go talk about epithermal systems and banding textures and different types of alteration, feel free to ask and throw it into the chat. But for now, I'll just show you how we can how these projects really drive value. It's important to know these are pit constrained ounces. So we run a whittle shell. It runs multiple simulations, just like a Monte Carlo simulation would. So we run them at a $1,500 gold price, $2 a ton mining, 4 processing, 2 G&A. We use 80% recovery. We know that the recovery on the oxide is around 80 to 85. On the sulfides, it's around 35 to 55. And the pit walls, we run it at 45 degrees. So very conservative. And right now we're sitting at 776,000 ounces and no strip, and the grade sits at 0.4. It should be noted, and we're going to talk about this later in the presentation, the average grade for Nevada open pit oxide is around 0.35, 0.38 in Nevada. Okay. So everyone gets caught up on grade. Mining, I don't like saying mining is easy, but it's like any other business in the world. It just comes down to margin, and we'll touch on that later on. What is this program designed to do? Is really to identify the plumbing system. So where is this gold mineralization coming from? Understand where the resource is open, where it's closed off, because it's not open in every direction. And really important to see is what the resource conversion rate is. So right now we sit at inferred, which is the lowest value, and then you work your way up to indicated and measured. We also need all that material for the geotechnical work to design the pit walls and for the metallurgy, okay? So right now, the current resource is this red line and above. All these blocks that sit below it do not sit in the current resource. All these gaps that exist that will be filled in this drill program are just relics of drill spacing. So they weren't drilled close enough. What we really see and what gets us very excited is the mineralized footprint is 2.3 kilometers by 1.2 kilometers, and the oxidation is about 150 meters. So if you use 2.7 for density, which is again conservative, in those metrics, and say 20% of that or 30% of that is actually mineralized, which is very conservative, you're looking at over 200 million tons of ore, okay? And we're currently sitting at 62. So the growth potential here, because the last group used the wrong model, And there was gaps in the claim block. And the other thing too is that in Nevada, there's two types of exploration permits. There's an NOI, which gives you 5 acres of disturbance, and then a plan of operations permit, which gives you basically unlimited. And the previous owners never had a plan of operations because they didn't have the cash to spend $1 million on a permit. And herein lies the opportunity for Wildcat and what gets me as a geologist and our team very excited. I'm gonna get on to Mountain View right now. This is the project that we're currently drilling. We have 3 holes left to be released. We'll get into some of the holes that we've put out and some spectacular intercepts. Again, these are pit constraint ounces using a $1,500 pet shell. The oxides leach around 80 to 85%. We used 80. Again, $2 a ton mining, 4 processing, 2 G&A. Just to put that into perspective for everyone, GSV just put out a detailed pre-feasibility study, and their costs were just under $8. So again, being very conservative on the numbers. The resource sits at 427,000 ounces and sitting at 0.57. Again, what the program was designed to do is identify the plumbing system. So the way these things form, and I'll show you in a second, is just think about them as a mushroom. The fluid migrates up vertically. It hits a more permeable horizon like these volcanics. And it has a nice disseminated cap with a high grade stem of the mushroom. So what we've done is we've identified the plumbing system. It's almost a meter of 141 grams. Okay. What we wanted to do is see where the resource is open, see what the resource conversion rate is, see where it's closed off. What we've noticed is that the grade is higher than expected. We've discovered the feeder zone, which is basically a vein that brecciates the volcanic rock. We can go into deeper detail later on. And the oxidation profile persists below 300 meters. And there's a lot of post-mineral faulting that breaks up the core. And why that's important is it's very important for the leach kinetics and how much you have to crush it before you put it on the pad. So it helps on your operating costs when it's really busted up, and it lowers your capex because you don't have to have three stages of crushing. The other thing to note is that the strip is not a real strip. So the waste rock that sits on top is this yellow material. And this is all composed of sand and gravel, as you see here. So it's what we call free dig. So it's not conventional drill and blast. So your mining costs will be, $1.50, $1.75, which will really have a positive impact on the economics. I think it's important to note here, some of these intercepts are quite spectacular. 128 meters of 1.73 grams, 20 meters of 2.3 grams, 275 meters of 0.5, 189 of 0.46, 232 of 0.9. So spectacular grade continuity is some of the best grade continuity I've seen. In our last hole 16A, this fills in a nice gap right here in the block model that ties the higher grade blocks together. So when we talk about resource conversion, we have a hole here and a hole here, and that distance is 100 meters. So to confirm that, to decrease the risk, we put a hole right in the middle to convert those blocks into increased certainty of what we believe is really there. So the resource conversion rate is coming along spectacular. The grade continuity is amazing. The grade, when you're looking at, 0.9 and 1.7, there's orders of magnitude higher than the average grade in the basin. So as I mentioned, the fluid migrates up these faults, hits a more permeable horizon like these volcanics. And what happens when you go from compressional tectonics to extensional tectonics, and you're supersaturating this permeable horizon, when you take off lithostatic pressure, you create flash boiling and cause the gold to drop out of solution. So this produces this nice open pit disseminated zone. And these feeders that sit right below it is exactly what we were talking about, that's 141 grams. So the way these things form is this fault now has been mapped for over 3.5 kilometers. Where you have these inflection points is areas where you have areas of higher fluid flow. Okay. So more fluid pumping up, and it has areas where you have more extension. So causing more gold mineralization to drop out in these zones. We see two other zones along the fault, which gets us really excited, and the feeder zone below it. I'm just going to touch on Red Canyon. It's an exploration story, so the market doesn't give us any value. So the market gives us value for Wildcat and Mountain View, and then everything, the Red Canyon, Cerro Colorado, Dune, Eden, Mar, Oslo, is all your blue sky and your free carrying. You don't pay for that. We drilled it right at the beginning of 2021, and I'm talking some spectacular intercepts. 54 meters of 4.5 gram oxide. Remember, the average grade in the basin is 0.35, 0.38. So again, orders of magnitude higher. What gets us excited about it really is that as an exploration geologist, what we look for is making sure that there's deep-seated faults, which it has. It sits on the same fault system as Cortez. It sits in the most productive horizon in Nevada, which is the Wenban Formation. And the age of mineralization is very important for Carlin style systems that predominantly produce the most gold in Nevada. And the age of mineralization needs to be between 30 and 40 million years. If it's not in that age window, it's not a Carlin, and the chance of mineralization is very, very rare. And our age date sits at 35.5 million years. So right at the peak of mineralization. For most people, I think this is the most important slide here. The way big companies and the way we always look at projects is you need to understand the grade divided by the strip to get your effective grade. The effective grade drives your margin. So what the strip ratio is how much waste rock is in there and how much ore is in there. And that's your strip ratio. So how much waste you have to move to get to the actual gold. And when you do that, Millennial has the highest effective open pit oxide project in the best mining jurisdiction in the world. There is a severe scarcity of these assets. Hasbrook, which is the next highest one, is very small resource. It's about 500,000 ounces. It's owned by a private equity group, so you can take that off. Northern Bullfrog has been gone. Gold Rock gone, Pan gone. Florida Canyon and Round Mountain are owned by big companies and Motherlode. GSV, just so everyone knows, that's a $220 million company, $250 million company, and they sit at 0.19. So the effect, what happens to the grade when you factor the strip, for example, is GSV sits at 0.7. So everyone thinks it's higher grade, but the reality is when you factor in the strip, it actually sits at 0.19. What we've done here is to show everyone what drives this. And like I said earlier, grade is not king, margin is king, just like any other business in the world. So I wanted to show you is that at $1,600 gold, okay, we're at 1930 today. At $1,600, the in situ value, so how much that rock worth in the ground, is $22. In a worst case scenario for the potential in situ margin, so how much is it going to cost us to get it out of there, is $11. Okay. That's a 50% margin at $1,600 gold. We bring it up closer to today's prices, you're looking at almost a 60% margin. Apple doesn't have that margin. And these are why these projects are so accretive to shareholders, is because the capex to put them in is extremely low. You're looking at $120 to $130 million. And the margin and free cash flow that these deliver are unlike any other projects out there. So, really where we see this going, and you may ask, why does GSV, who has the same amount of ounces as you guys, trades at 174 million US, and we trade at 64? Why that is because through the exploration life cycle of projects, there's certain things that you need to do to de-risk and increase the certainty of what's there. So right now, the reason why we trade at 0.2 times NAV and not 0.5 times NAV is because we need to do the met work. We need to see what the resource conversion rate is, and we need to do the geotechnical work. The reason why Franklin Templeton and Investcorp and Merck and Eric Sprott put money in at 0.2 times NAV with us is because we've done this 7 times and we put up 60 million ounces. 5 of those are in construction and production today. So they know that we're going to do the proper systematic scientific work and that they can pick up something at 0.2 times NAV. And once we complete that work this year and we put out the PEA, there's going to be a significant re-rating opportunity. And that's just on the current resource base of 1.2 million ounces. There is clear growth north of 2 million ounces. And that's, again, another blue sky in your free carry. So trading in line with our peer group once the PEA is released is really where we see this going. And the PEA we should have out in the early 4th quarter. I think it's really important, as Anthony mentioned earlier, is we believe in systematic, scientific, aggressive exploration. And one of the things that kills junior companies is time. And people forget to factor in the time value of money into these things. And since going public in May of 2021, we will have gone public on 2 exchanges, raised $24 million, drilled 20,000 meters across 3 projects. We have 5 analysts covering us. We'll have done 4 resource updates and a preliminary economic assessment within 18 months of being public. I can beg to differ. There's not another company that's been that aggressive. And what that allows us to do is deliver value to shareholders quicker. And what it also entails is that we have a very catalyst-rich story and a very tight float. You're only looking at 23% float on this thing. So over the next couple of months, you'll see results from Mountain View. Drilling will begin at Wildcat in April once the snow buggers off. You'll see the initial met work, so further de-risking. You'll see the updated resource. We're looking around 1.5 million ounces from 1.2 and see a lot of great resource conversion. We'll see drill results from our second phase of Red Canyon. And then the real value driver is the PEA that gets you from 0.2 NAV closer to your peer group at 0.5 once we de-risk this project. And that's why smart money, the big institutions, come in now. So they participate in that re-rate as we progress. Just to wrap it all up in a nutshell, and I'm not even going to talk about Dune, Eden Mar, Oslo, or Cerro Colorado. That's just part of our growth pipeline. They're all early stage exploration projects, but that's part of your blue sky and your free carry that you get with this very diversified portfolio of assets. It's important always. Everyone says they have an excellent management team. We've done it 7 times, almost 60 million ounces. We've done this. It's not our first time. It is the #1 mining jurisdiction in the world. Everyone says tier 1 mining jurisdiction. The reality is, by the Fraser Institute, Nevada is #1. It's the 4th largest gold producer in the world if it was a country. You have a significant resource base already that will add to and further de-risk. These assets are extremely low capex. To put it in perspective for everyone, for an open pit oxide project to do 125,000 ounces per annum, that in a sulfide project in an orogenic vein system, the capex would probably be around 400 million, 300 million. So significantly lower. The other important thing is that the cost per discoverable ounce. So how much drilling do we have to put in to build the resource base? In these systems, it's around $5 to $8 million for 1 million ounces. In orogenic vein systems up in Canada, in the Abitibi in BC, for 1 million ounces, you're looking at $30 to $40 million to drill it. So as the largest shareholder, individual shareholder, other than Eric Sprott, I'm very cognizant of dilution. And one thing junior companies forget is that, drilling costs aren't a sunk cost. The shareholders need that money back. And we're very cognizant of that. You have a significant institutional shareholder base that you will never see on companies sub $100 million market cap. And it just speaks to the track record of our team and the quality of our team and the projects. And lastly, you get a significant re-rating opportunity in the very near term with a strong gold tape going into the later years because of the geopolitical risk. And, you're seeing CPI inflation numbers at highest since the 80s. With that, I'll open it up for questions, and thanks for listening, everyone out there.
Yeah, thank you, Jason. We at Torrey Hills Capital, we look at a lot of exploration companies, and we actually are approached by a lot of exploration companies, and we turn a lot of those companies away because we just don't think they're ready, or there's just the timing's just not right. But for us, Millennial checks all the boxes. I mean, if you to pound home the point that Jason was just making, I have never seen a company with a sub $100 million market cap that has this kind of institutional ownership. They're in the best jurisdiction. The numbers speak for themselves in terms of margins and capex. It's just really, I think, well positioned to just be a multi-million ounce producer, excuse me, in the future. So we're really excited about the company, and a lot of the investors that we've spoken to who we've shown the company are really impressed. So it's really worth taking a look here. So as Jason mentioned, we are going to open it up for questions. There's already a question in queue. If you have a question, the easiest way is to simply type it into the Q&A or chat box, and we'll make sure it gets answered. It's a good question. What's the ultimate goal? Operate, sell off, royalty?
Yeah, Anthony, it is in our technical and financial capacity to build these things.
Mm-hmm.
I would love to build them. These types of projects are really company makers. This is how Clive Johnson started with Broma Gold and B2 Gold. Okay. These assets pump out free cash flow. I would love to build them. Our team would love to build them. And I don't have an ego. I don't need to build a mining company. If someone says, right now we trade at $30 on an EV ounce basis, industry average probably around 50. Someone says, here's, the average acquisition cost, the last one went for $95 on an EV ounce basis. So if someone gave us, $100 an ounce, I'll gladly walk away.
Yeah.
One of the things that it really bothers me with the industry as a whole, and especially the junior mining industry, is companies say, oh, we're going to drill this project out and we're going to do PEA and we're going to sell it. And frankly, you cannot build a real business around that model.
Mm-hmm.
Selling a project is not in your control. So what's in our control is to add ounces, de-risk ounces, and put this in a permitting pipeline as fast as humanly possible to deliver value for the shareholders by bringing the production profile forward. Okay, so once we do the PEA and we have the plan of operations permit, we can then do the condemnation holes for the pads and the ponds. So you're looking at getting, into a permitting pipeline for the mine permit by the end of 2023.
Yeah.
That's how you deliver value.
Absolutely. All you can do is execute. And if someone comes along and, wants to buy the company, then that's fine. But you have to worry about the day-to-day. And I get it. And, also, I really want to drive home the point as well that management has put their money where their mouth is. Jason mentioned earlier that he's taken a large position in the company. I know that Jason Banducci has also taken a position in the company as well, at prices probably slightly higher than where they are now. So you have an opportunity to, buy into a company at a lower price than what management has paid for. And I think, I've seen a lot of these junior miners really just dilute shareholders by continually doing raises. And I think, Jason understands that the more he does that, though, he's hurting himself essentially. So I think you'll probably be very smart about raising, money, and I think that's really important.
Yeah, absolutely, Anthony. And there's ways we can raise capital that are I hate when people say non-dilutive financing. Everything is dilutive. It's either on the asset level or on the equity level.
Mhm.
So there's ways, because the reality is we will need to raise money at some point towards the end of the year. That's just reality. But because all of these assets have a low royalty burden, so the largest is 3%, sub 5% in Nevada is rare. These were our highest ones 3. So royalty companies will give you money at 0.8 NAV. Okay, we're trading at 0.2. Even at 0.5, you take that all day. So it's 3.8% NAV dilution or 35% equity dilution. It's a no-brainer what we would do.
Yeah.
And I guess one thing, Anthony, is what will, the question is what we want to do. The reality is that gone. These guys are big companies, gone. This is 250 million, and this is basically gone. So the reality is that there's a severe scarcity for these things. And as much as I'd love to build it, I don't think the mid tiers would let you do that.
And Jay, I'll just jump in. I mean, I spent five years of the last 7 years on the banking side and 5 in mining investment banking. And, you've seen it in the recent M&A trends. People, especially large mining companies, are not looking to expand operations or purchase new properties or projects in West Africa, Russia, for obvious reasons. So everyone's looking to safe, stable jurisdictions. And if you look at the chart that Jason just walked through, that speaks to exactly that, right? You see Anglo Gold come in buying assets. You've seen Caliber Mining, same thing, right? They don't want to operate in Nicaragua. They want exposure, NAV exposure to a safe jurisdiction that is predictable, right? Where they can actually harvest cash flows without worrying about the government coming after them. You don't have to worry about terrorists. This is Nevada, right? And not on this chart is a couple of weeks ago, you saw Centerra buy Goldfields off of Waterton, right? Centerra has never been a North American operator, has never operated in Nevada, but following the same trend. They bought Goldfields off Waterton. It's a slightly more advanced asset than what we have, but they paid over $130 US per ounce in the ground. If you look at, again, if you want to flip to the comp tables, we're trading at $40 an ounce, 130 versus 40. So as Jason said, it's not in our control to just sit back and say, look, this project's going to sell. But based on what's been happening in the market and the scarcity value of these assets, I would be surprised if we got to a production decision, because everyone wants NAV exposure in safe jurisdictions, and Nevada is the best of the best.
Yeah, and I've spoken with several executives for other companies that are actually in production, and good properties are scarce. They can't find them, and a lot of them, even in some of the safer what were considered the safer jurisdictions, like even Mexico, don't have as much stability as they've had in the past. And who knows if
it's year by year, right? It's like, look at Argentina,
really
look at Spain, look at Brazil, all these countries that, have wonderful gold endowments. You just don't know what's going to happen year to year based on the political instability. And again, when we put this company together, it was Nevada by design, and it was these types of deposits, the low sulfidation epithermals by design, right? Jason's worked all over the world. He's drilled much, much tougher deposits, and he's worked in much more challenging countries. And again, when he decided to leave the Cisco group and build a company on his own, it was Nevada and it was near surface oxide. So it's all by design, and it's all based on the experience that both our management team and board has gained by doing this many times.
Absolutely.
we've looked at, when we were at the Cisco group, that we did all the work for Cisco Gold Royalties, Cisco Mining, Mineral Alamos, Barkerville, and did a lot of geological due diligence. We've looked at over 3,000 projects globally. Okay. As I mentioned, we looked at 337 on a desktop review for this project, for this portfolio. We looked at 47 projects at a site level. So these were hand selected for the exact reasons that we just discussed today.
Yep, absolutely. One of the questions that came in is, what is the cash burn this year? I guess, that'll all depend on what your drill schedule is and things like that. Can you talk specifically about that?
Yeah, totally. So right now, like I said, we're just around 12 and change. Depending on how much we drilled that in that month, you're looking at 1 to 1.5 Canadian a month. It should be noted that 87% of the money goes into the ground. Okay. So very low G&A burn. The only people that are in our Toronto office is our CFO, Banducci, and myself. Everyone else is at site. So, everything goes in the ground to really drive value and not, overinflated salaries for executive teams.
Yeah, and that's great to know. So, I mean, I think I hope I'm not putting you on the spot when I ask you, Jason, but how much do you think the resource update will change?
Yeah. So again, Anthony, I as a geo that I've done this multiple times, I could say we could probably push it to 1.5. Okay. But remember in Nevada, so I just want to go to this slide here. So in Nevada, the reason why we're drilling all in this area and not in this area, or not over here, is because we're confined to the NOI. Okay. That's your notice of intent that gives you 5 acres. Because we inherited that permit, we inherited with 4.8 acres of disturbance. So we can't go drill over here. We can't go drill over here or over here because we don't have the disturbance. We can't make the roads. We can't make the pads. But as I mentioned to you, let me just get a different color here. You're looking at 2.3 by 1.2 kilometers by about 150 meters in depth. So, where do we see this going? I think there's clear visibility to push this over 150, closer to 200 million tons. We currently sit at 62 million tons. So once we have a full permit, I think, growing this north of 2.5 million ounces is where we see this going. But I want everyone to understand that the next resource is going to be around the 1.5 because of the permit we're under. Once we have the fuller permit, that's when we're going to see the big growth. And, we'll just drill it to inferred. So we won't do the conversion because we'll already know what the conversion rate is. So cognizant of dilution. And as my old boss and mentor, Sean Ruzin, who is the founder of Cisco, it turns into the SUDS program, which stands for Shut Up and Drill Stupid. But at least we've done, in order to do that, you need to do the proper systematic scientific work, understand the conversion, understand the met, understand the geology, and then you can go do that. And that's really where you're going to see us add a lot of tons, which will have a massive positive impact on the project now.
Yeah, as we start to come out of COVID, are you seeing any issues, with getting permits and things like that? I know there was a little bit of a jam in terms of getting permitting.
Yeah, so Nevada's pretty good for permits. They give you pretty good timelines. That said, the offices were closed. So you actually had to drop it off. It was only open 2 days a week, Tuesdays and Thursdays. So was there a delay? Yes. Is it a major delay? No. So I think we'll see the plan of operations permit in the middle of 2023.
Great. And then, I know everybody, one of the most important things investors look for is infrastructure. And we can't emphasize enough, around the resources. Like, I think Jason one time said that you can actually order a pizza from.
No, literally. So this is one of the main highways that comes literally right by the project. And there is a pizza shop right here. You could probably order it to the pit. I always forget to talk about infrastructure, but there's literally the major power line runs like this through
Yeah.
Nevada. So we can pull 3-phase for that. There's a major highway right there. There's a rail line that goes right through here. So I just assume, sorry, I should have brought it up, but when you talk about Nevada, why it's so good is because there's infrastructure everywhere.
Yeah. And I know that it's probably, self-explanatory that it should be there, but sometimes you never know. And I think that's really an important point because, we've dealt with other companies who need to, do major, work to bring in water or electrical and things like that. This has everything that they need in order to build a mine, in order to achieve their goals in terms of infrastructure, which is very important. So I think it's very important to kind of drive that point home.
For sure. And it lowers your capex, right? So, a lot of junior companies, why they don't re-rate off a PEA is because they're $100 million company with a 500, 700 or $1 billion capex project sitting on their head. And, that's never going to go anywhere. But with these, you're only talking about digging the pit, you have the pads, and you have your crushers, and then your ARD plant to strip the carbon. So very low capex. You're looking at 130, 150 million, as opposed to 300, 500, 700 million dollars. And in an inflationary environment, we don't have to build a mill and have a ball mill and have all the cyanide tanks. We don't have to do that. So these projects, like I said, in an inflationary environment, which we're in, are the least susceptible to inflation.
Yeah, and I've worked with a silver producer in the past who's just about to build, a mine in Mexico, and their capex is going to be. It keeps going up, unfortunately. I think it'll be a profitable project, but it keeps going up, unfortunately. And that's just, a lot of that has to do with costs that are impacted by inflation. And so it's good to know that you're not going to have such an issue, such a major issue as other companies out there doing it. Let's see. Are you seeking to expand the land holding around Wildcat?
Already done. Press release going out next week.
Ooh, that's good news. That's great.
I think we've almost doubled the land package.
Wow.
So there's a good slide. Basically, what we've done is to the north here, the major highway that connects Mountain View and Wildcat is basically right there. And all this flat lying area is perfect for leach pads. And the power line is over there, and our water rights are in that basin. So we staked a lot of ground to cover to get to this road. And again, this is just from doing this multiple times.
Mhm.
There's also very prospective areas like this guy over here. There's another zone down to the south. This white material is what you want to look for. This is all this volcanic stuff. So we've significantly increased the land package at Wildcat and at Mountain View, both for geological prospectivity, but also, we got to think 3 years down the road. And we don't want someone cutting off our access to the power line, to the water, to the highway. So we've also staked land for that reason as well.
Yeah, and how far away are those properties from each other?
It's about 45-minute drive. So it's important when you truck the loaded carbon, it's basically in metal steel vats in the back of a pickup truck because it's so concentrated. When I was when we were with Minera Alamos, at the Santana project, we would actually truck the loaded carbon from Chihuahua, Mexico, all the way up to Metals Research in Idaho to strip it. So it's not very costly to truck it. Reason why we did it in Mexico, and this is why we don't like working in Mexico anymore, is because the narcos, if you're pouring a Dore bar, one of the mining companies, I won't name who it was, the narcos flew in on a private plane with a bunch of guns and robbed the mine of all the gold they poured. So again, we don't want to deal with that. But it's not like people don't truck the loaded carbon to a centralized stripping facility. People do it all the time. And it saves about 20 million, 25 million in year from the CapEx to have one.
Yeah, and that's another important thing that you just mentioned. Being in the US, you don't have to worry about, security and things like that that are really important in other areas. Can you talk about the ownership structure of the properties in terms of like royalties and things like that?
Yeah, so we own Dune. Let me just go to a slide. We own all of these guys 100%. The largest royalty burden on Mountain View and Wildcat is 3%. It's shared between a bunch of royalty holders. Dune, Eden, Mar, Oslo didn't have any royalties on them. So we granted Waterton a 2% NSR when we did the deal, but we have the right to buy back 1% for $1.5 million. Red Canyon is an earn-in agreement, so back end heavy. It's an earn-in agreement over 4 years with a $2 million trigger at year 4 to purchase the option. That shockingly, on the most prolific trend in Nevada, had no royalty. So we granted them a 2%, but we have the right to buy back 1%. And the project we didn't talk about, Sierra, Colorado, is a massive land package, over 10,000 acres. Okay. It sits in the copper porphyry belt just south of Tucson. And what there's a bunch of high grade, vein stockworks on these hills. We're talking, 1,300 grams of silver in the samples on surface. And this property did not have a royalty on it either. So we granted them a 2% with the right to buy back 1%. It's also an earn-in agreement over 4 years, back end heavy, with a $2 million trigger at year 4.
Gotcha. What does it cost to carry those other properties, like Dune, Eden, Oslo?
So the whole cost to hold the whole portfolio for all 8 projects is $329,000 US a year.
Wow, that's very reasonable.
Yeah, there's other places. Mexico, once you get your title, it's very, very expensive to hold the land.
Yeah,
but
for sure.
Before title, it's quite cheap.
Yeah, no, absolutely. We don't have any more questions. I think we're gonna leave it there. Look, for those of you who have joined us today, I have to say that we really work with Millennial for a reason. Like I said, they check all the boxes for us. Obviously, the management team knows what they're doing. We feel like they're very capable of taking this project into production if it even gets that far. I have a feeling that there are going to be a lot of other larger mining companies who will be interested. But you have institutional ownership for a sub-$100 million company, market cap company that we've never seen. We've had heavy insider ownership. They're in a great jurisdiction. They're managing their cash well. I mean, it really, like I said, it checks all the boxes for us. And I really feel it's worth taking a look down here 100% because of where we're setting up to in terms of the fundamentals for gold, all the geopolitical issues that we're seeing now, as well as, like Jason mentioned earlier, inflation numbers that we haven't seen for 40 plus years now. I just think it's a nice setup for gold. And so really take a look down here, and the stock has actually started to move up in the last few weeks. So in a trades quite a bit of volume. There's a lot of liquidity there too, in our opinion. So I want to thank both Jason Kosec and Jason Banducci for coming on today and introducing us to this company. We feel like it's well positioned to become a multi-million ounce producer. Jason Kosec, would you like to leave us with any parting words before I wrap this up?
Yeah, thanks, Anthony, and thanks for everyone for listening. Like Anthony has mentioned, there's not many of these left, and mining is, like I said, isn't simple. But when you look at it, it just comes down to margin. And the way we build companies, and the way Mark Bristow from Barrick builds them, and Clive Johnson builds them, is that in any gold environment, I don't think gold's going below 1,600. Personally, I think it's going through 2,000. But even if the worst case scenario, at $1,200, you're still at a 32% margin, and that's how you build a real business, and that's what we're doing here. So, for everyone who jumped on to Clive Johnson's B2 after he sold Roma, that's a 1,600% return from the beginning, and you're getting in with all at the same level as the institutions and myself and Banducci. So, yeah, without that, it'll be an exciting year for us. And thanks for listening.
Yeah, appreciate it. And we'll keep an eye out for drill results as they come in. We'll definitely get those out to the group as well. If you want, if you had any questions that weren't answered today, feel free to reach out directly to me. Call me, email me. If I can answer it, I will definitely reach out to Jason Kosec or Jason Banducci, and we'll get it answered for you. If you are looking for additional information on Millennial Precious Metals, visit the company's website at millennialpreciousmetals.com. Get info on the company's current projects as well as its latest press releases. I want to thank all of our attendees for taking the time today to join our call. The code word for feedback is nugget. I'm going to send out the feedback link right at the conclusion of this meeting. Your timely feedback is greatly appreciated. It's very important, not only to us, but to our clients as well. So with that, we'll leave it there. Thanks again, Jason K and Jason B. We appreciate it. And I will talk to you next Tuesday.
Awesome.
Thanks, everyone.
Thanks a lot.
Thanks. Take care.
Bye.